Welcome to Montage Informative Videos. Today we're going to talk about transfer pricing. Before we do so, let me just give you a brief introduction of who Montage Services is. It's a professional service organization of accountants and lawyers who are there to assist organizations with their U.S. tax matters. We have offices in San Francisco, Houston, Toronto, London, as well as in Germany. Now, transfer pricing is a topic that goes to every country's fiscal heart, in that each country is trying to tax a corporation's income. And how they do so is based generally on the economics of the functions and risks borne in each jurisdiction. So transfer pricing is a way that related companies transfer either pricing as it relates to goods or services or financial transactions, and there's always a question of whether or not they're doing that in order to reduce their overall tax burden, or is it because one entity in a different location has taken on more risk and benefits than another jurisdiction. Some people view transfer pricing as a compliance necessity. There has to be support for one's company's transfer pricing. But other people take a look at it as an opportunity to see how they can reduce the overall group corporate effective tax rate. So what we'll do here is touch upon some of the provisions as it relates to U.S. transfer pricing. There is OECD model treaties that talk about transfer pricing, and every country has their own transfer pricing rules. So in order to effectively take care of this area, you have to look both to the U.S. country rules as well as the opposing country's rules. Okay. So a controlled enterprise is the starting point of a transfer pricing discussion. What is a controlled enterprise? It is a company that has a related party, which is generally denoted as one which is greater than 50% owned. In this example, on the left, we have Group 1, which has 3 related companies. Why? Because they're all greater than 50% owned. On the left-hand side, we have Group 2, which has one company that's related, but one company that's unrelated. That unrelated company, if it had a transaction with holding company number 2, would not be subject to transfer pricing rules. Why? Because it's less than 50% owned, and therefore it's deemed to not to have control. What are some transactions that might be subject to these provisions? In essence, any transaction between two related companies is subject to the transfer pricing rules. In tangible assets, there might be a sale of a good or a machine. In other words, let's say you have an Australian company that's selling a stuffed kangaroo to the United States. That stuffed kangaroo comes over at a set price to its sales distribution subsidiary in the United States. That price that it's selling to its distribution company is the transfer price. Obviously, intangibles are this area where royalties are used to determine what is the appropriate transfer price between related companies. If a company has provided its subsidiary some know-how, that subsidiary should be paying a royalty back to the parent company for use of that know-how. There are often services that are used, either grouped in a manner or held by the main parent company and provided to the subsidiaries. Those can be HR services, accounting services, marketing services, and legal support. And finally, there are loans and guarantees and leasing of goods which fall under the financing transactions. If we look to a transfer of a good, which is the easiest one as an example of what transfer pricing is, if we had a parent company established in Luxembourg that then was manufacturing, say, an automobile in Germany that is sold to a distribution network in the United States, that sale of the good from German to the U.S. subsidiary is a transfer pricing question. At what point, what price should that good be sold? Obviously, the same is applicable for services and can be between the parent company or between related companies, but in essence, it is the price for those services. Should they be marked up or are they provided at cost? Our U.S. rules indicate that if it's not integral to the business, it does not need to be marked up. So if, let's say, this Irish company were providing accounting services on behalf of the UK company, there would not need to be a markup under the U.S. rules. Less often do we come up against financing transfer pricing questions, but it does come up whereby it is raised, what is the appropriate interest rate to charge? Well, in the United States, the government actually lists out what are the appropriate interest rates. They're known as the applicable federal rate and are published each month depending on the type of loan and the length of the loan. Now, as you can imagine, the U.S. rules do not dictate other countries. So other countries may say, for instance, in India, where they believe that their development of intangible property is something that's very valuable to any organization, they want a higher markup than what the U.S. might accord the same services being performed in the United States. It is that playing to both jurisdictions that makes transfer pricing very interesting and is usually done in conjunction with economists who are supporting the pricing that is being derived for each of the related companies. What our rules say here in the United States is that the taxpayer must defend its transfer pricing based on what's known as the arm's length principle. What is the arm's length principle? It is first hard to say, but secondly, it is what a taxpayer would charge a third party rather than just charging itself. So if they can demonstrate to the taxing authorities that the price they've charged their related company is what they are charging a third party, or have support for the data that is surrounding third-party transactions, then that will provide support as it relates to the transfer price. There's usually reports that are done each year as it relates to transfer pricing. Unique to the United States is we don't need to provide those reports to the IRS or to our government when we file the corporate tax return. In other countries, it is a requirement to have an annual submission of the transfer pricing documentation. However, there is a roadmap on each corporate tax return as to what the transfer price might be and the related party transactions. These are demonstrated in the Forms 5472s and Form 5471s. And each company should have documentation as it relates to the business, the best method that they've used in deriving the transfer pricing, and then the support of the economics of the transfer pricing. We've touched on here the transfer pricing provisions as it relates to the United States. It is a topic that is complex and it's also specific to each individual taxpayer. If you have other additional questions, we ask that you reach us either on the web or by calling us, and we'd be more than happy, and our economic team can put together transfer pricing reports for an organization. Thank you. Are there any questions? Yes.
What date does the documentation have to be put in place?
The documentation for transfer pricing needs to be in place within 30 days of request. So if a taxpayer gets an audit notice from the IRS, and one of the things they will request is their transfer pricing documentation, the taxpayer has 30 days from that date of the information document request to provide the IRS its support. That's why most taxpayers put the reports together prior to getting an audit notice, because 30 days is an awful short period of time. Yes?
How often do you have to document your transfer pricing agreements? Every year, every 2 years?
So the question was raised, how often does a taxpayer need to document their transfer pricing? In the United States, it is required to put your transfer pricing documentation based on the economic facts of an organization for any given year. However, if there has not been a substantial economic change in how the business is doing its functions, then that same report may be used in future periods. It is up to the taxpayer to determine if there has been functional changes in the way it's operated such that it might need to refresh a transfer pricing report. Thank you very much for listening.